In this video, I'm talking about 8 ways to boost 401k savings right now. Hey everybody, it's Matthew Jackson here from 401k Maneuver. We provide online professional account management for your 401k with the goal of supercharging its account performance. So stop leaving money on the table each and every year in the form of lost returns. Let us help you. If you're new here, be sure to hit the subscribe button, and the links to everything that we mention in this video you can find in the description box below. So let's get started. If you really want to boost 401k retirement savings, the obvious solution is to save more. But that's easier said than done. Otherwise, more people would be on track for a better retirement. Now, there's a crisis, a retirement crisis in America that's been brewing long before the pandemic hit. According to the June 2021 National Retirement Risk Index report from the Center for Retirement Research of Boston College, half of today's households will not have enough retirement income to maintain their pre-retirement standard of living, even if they work to age 65 and annuitize all of their financial assets, including receipts from a reverse mortgage on their homes. Now, according to a recent nonprofit Transamerica Center for Retirement Studies report, 82% of workers are saving for retirement through employer-sponsored plans, such as a 401k or similar plan, and or outside the workplace. Baby boomers, 84%, and Gen Xers, 84%, and millennials, 82%, are more likely than Gen Z, 70%, to be saving. Now, when it comes to how much they're saving for retirement, the study found total household retirement savings among all workers is on average, or the median, $93,000. Baby boomer workers have the most retirement savings at $202,000. And other age groups reported the following estimated median savings. Use this key to measure up to see how you're doing. Gen Xers, who were born from 65 to 1980, $107,000. Millennials born between 1981 and 1996, $68,000. And Gen Zers born between 1997 and 2012, $26,000. So how are you doing? It's clear Americans need to be saving more if they don't want to struggle in retirement. So keep watching for 8 tips on how to save more to boost 401k retirement savings this year. First, at least get the company match. Meeting the company match is an easy way to boost 401k retirement savings. All you have to do is put in what your company matches, and it's basically free money. Now, depending on what your company matches, it may double the amount of what you're already saving. Company matches vary from employer to employer, so make sure you know your plan rules and how much you need to save in order to get the full match. For example, your employer might match 3% of your pay, but you're required to contribute 6% of your salary in order to get the full match. It's also important to know your 401k plan's vesting schedule, because depending on your plan's 401k vesting schedule, you may not own the money your employer contributed until you're fully vested. If you are unsure about your vesting schedule, we recommend you contact your HR department to find out. And check out the description box below for a complimentary read titled 4 Ways to Potentially Maximize Your 401k Company Match. Second, save additional money that you receive. A way to easily boost 401k retirement savings and do so without reducing your take-home pay is to immediately contribute a portion or all of any additional money you receive to your 401k. Check this out. Should you receive a bonus, inheritance, or an unexpected cash influx, redirect it into your retirement account. The same goes for tax refunds. Remember, if you add to your 401k, it needs to be done through payroll deduction. We recommend you contact your human resources department, tell them the amount that you want to invest, and they will take it out of your paycheck or paychecks. Then use the additional money received to live on and make up the difference during this time. Third, alter your spending habits. Living beyond your means and overspending plagues all income brackets, it's no lie. Not only does it cause financial strain and stress, but it can also significantly impact the amount that you save for retirement. And if you carry the habit of overspending into retirement, it can seriously hurt your retirement lifestyle. You don't have to cut out a lot. In fact, you'd be amazed how much more you can save in your 401k just by cutting out a few $100s of your monthly expenses and applying the money saved to your retirement savings accounts. Let's say you found 3 subscription services to cut and decided to cut back to eating out to once a week. And let's say the dollar amount cut each month totaled $257. Multiply that by 12 months and you could save an extra $3,084 a year in your 401k. Now, while that may not seem like much, cutting just a few expenses each month adds up over time and may make a big impact on your retirement nest egg. So curbing spending means forming a new habit of living within your means. So take it one step at a time. Try it for 30 days and see what happens. Do yourself a favor, check out the description box below for a complimentary read titled Pay Off Debt or Save for Retirement. Which comes first? Number 4, contribute your raises. While we're on the subject of contributing more without reducing take-home pay or significantly altering your lifestyle, contributing your raise is an easy way and really powerful, if I might say, to boost your 401k retirement savings. So the next time you get a raise, designate the extra income for your retirement and put it directly into your 401k, or take a portion of it and apply it to your 401k. If you do this immediately, when the raise takes effect, you won't miss the extra money because you will never see it reflected in your bank account. Hey, if you're still watching, please hit the like button, make sure you subscribe to our channel, and hit the little bell on the right to receive notifications of our next posted content. Number 5, take a second job or a side hustle. If you can't find a way to save more in your 401k without stretching yourself too thin, consider picking up a second job or a side hustle and use that additional money to boost 401k retirement savings. Use the extra money earned to live on, and then contribute more from your paycheck to your 401k. Number 6, avoid target date funds. More and more employers are automatically enrolling employees just like you into their 401k plans. In fact, more and more companies' 401k plans use target date funds, and you've seen them on your statement. They look like 2030, 2040, 2050 funds as their default option or qualified default investment option, also known as a QDIA. Now, the Pension Protection Act of 2016 allows employers to direct plan participants' assets into a target date fund and not be liable should the employee not select the investment. MarketWatch states about 70% of U.S. companies automatically enroll employees into 401k type plans, and more than 86% of these firms now direct people's money by default into target date funds. According to Vanguard's How America Saves 2021 study, roughly 4 in 10 target date fund investors chose funds on their own, not through default. This means that 6 out of 10 have no idea what they selected as an investment and are automatically enrolled in the default plan. Here's why this may be an issue if you're one of those investors. Target date funds are based on the date of expected retirement. If you're younger and plan to retire in 2050, you're told to select a 2050 fund. If you're wanting to retire in 2030, you've been told to select a 2030 target date fund. Now, target date funds fail to take into consideration your salary, your profession, your risk tolerance, goals, and objectives. You are put into a fund based on your expected date of retirement. That's it. In addition, target date funds may not appropriately manage downside risk. They may underperform in good markets and do a poor job of managing downside risk during tough markets. According to Morningstar analyst Jeffrey Holt, in the long run, the biggest risk in target date funds is that they won't meet investor expectations for avoiding losses. Wait, what? Those looking to maximize 401k performance in 2022 should think long and hard about sticking with the default target date fund. There are other investment options available to you where you can take into account your risk tolerances and your unique goals and objectives. Number 7, rebalance your 401k Far too many investors set up a 401k, fund it year after year, but fail to regularly rebalance their portfolio in order to maintain the initial desired level of asset allocation. This buy and hold strategy may do more harm than good. Now, what is rebalancing? Rebalancing is the process of realigning the weightings of the assets in your portfolio to stay in line with your risk tolerance and your timeline for retirement. This can involve periodically buying and or selling assets in the portfolio in order to maintain the initial desired level of asset allocation. Now, when you fail to rebalance, you're essentially turning over your investments and your future retirement income to chance and missing out on earning more and keeping more of your hard-earned money. Be sure to check the description box below for the complimentary read, What Every Investor Needs to Know About Rebalancing a 401k. Number 8, get help. If you need help with rebalancing your 401k or any other tips, consider getting help. Here's why. Studies show that getting help from a financial advisor may increase your retirement income and may greatly impact the type of retirement lifestyle you can afford. A 2019 study titled Advisors Alpha from the Vanguard Fund Group reported a 3% average increase in the value of portfolios of clients who work with a good financial advisor. This return, the study states, depends on the client's situation and will vary from year to year. David Blanchett, certified financial planner and CFA, published a 2014 study during his time as head of retirement at Morningstar titled The Impact of Expert Guidance on Participant Savings and Investment Behaviors. The report revealed that participants who received expert guidance had as much as 40% more income during retirement versus those who received no help at all. How would 40% more income impact your lifestyle in retirement? If you've been hesitant to reach out to a professional for help with your retirement savings, there's no time like the present to take action. Use our retirement calculator to see how professional management may help improve your future retirement income. And check out our no-cost guide on the different types of licenses financial advisors have and what they mean to you. That's it for today, everybody. Do us a favor, if you found this content valuable, share it with the people that you love, trust, and respect. We'll see you next time.